Hello students, welcome to the first video lecture on the paper Security Analysis and Portfolio Management. So today we'll discuss the first unit. So in first units, the topic that we will be covering include meaning of investments, scopes and process of investments, investment alternatives, risks in investments which include systematic and unsystematic risks, and finally we'll discuss fundamental of risks and return. So, talking about investment. So, what is investment? Okay, so any kind of investments or any when you put your money into a particular assets with a hope that it will grow after in future or it will fit you a profit in the near future. So, when you invest your money on a particular asset for a period, uh, that that is investment, right? So now what is securities? So security is a kind of investment, an investment which are tradable in the stock market. Okay, so like if you have like invested in a company's shares, so that investment will be considered as securities. But when you invest your money, when you suppose when you buy a property or a plot of land, that is simply investment. That is not security. Okay, so securities are those investment which are tradable in the stock market. So securities can be in the form of fixed securities, variable securities, convertible securities. Okay, so fixed securities, it includes bond, government bond, or any company debentures, okay, where the principal amount and the maturity amount is known with certainty. That means suppose you have purchased a government bond, okay, or you have purchased a company debenture. Now government bonds or company debentures, it has a uh, fixed maturity period, say for example 10 years or 20 years, and fixed rate of interest, right? So any securities with principal amount at fixed maturity period, that is considered as fixed securities. Next is variable securities. So variable securities, these are the kind of investment where the maturity amount is not known with certainty. For example, if you invest in company equity shares or company preference shares, now when it will be matured, it is not known, it is uncertain, because you invest in a company shares for an indefinite period, right? So it company preference shares or company equity shares are never redeemed. Okay, the principal amount are never returned back to the shareholder until and unless the companies wind up. Okay, whenever there is winding up of company means whenever there is closing of the company, in that situation only the companies pay back their principal amount to the equity shareholder and preference shareholder. But in case of preference share, there are certain preference shares which are redeemed. Say for after 20 years or 30 years, the principal amount are returned back to the preference shareholder, but not in case of equity. So that's why it is known as variable securities. Next is convertible securities. Convertible securities means those investments now which can be converted into other form of investments. Say for example, the debentures of a company can be converted into preference shares, and preference shares is convertible into equity shares. Okay, so all these are tradable in the stock market. That means all these investments can be traded in the stock market. You can buy and you can sell the securities in the stock market. Now next topic that we will discuss is portfolio. Now what is portfolio? So portfolio means simply investing in a group of securities. Say you have invested in shares. Say for example you have invested in Reliance shares, as well as you have also purchased the debentures of Tata Motors. You have also purchased government bonds as well as other securities, right? So when you hold a bunch of securities, a bunch of investment altogether, it is known as portfolio. So a portfolio is a set or a group of securities. Next is talking about the investment. Investments can be defined as an economic activities, right? It is an economic activities where buying and selling is taking place. Okay, so it is an economic activities which involve creations of assets and exchange of assets with profit motive. So investment is all about creating an assets, okay, or an exchange of assets with a motive of making profit. So investment can also be defined as a process of sacrificing something now for the prospect of gaining something later. Now, if you have invested your money in a company or in bank account, that means you are sacrificing your money uh, right now. Okay, you are sacrificing your needs right now in order to gain later on. If you are sacrificing your needs and wants right now, and you have put your money for say for 1 year or 2 year with the company shares or with the bank, then after 1 or 2 year you will be getting some interest on that, right? So it's a process of sacrificing something right now for the prospect of gaining something later. Or it can also be defined as it's all about employee of fund for the purpose of earning income and growth of the value. Okay, now moving on to the next topic, that is different alternatives of investment. So different alternatives means various options of investment. There are various investment options which are available to the investors. Okay, now it depends upon the investors what kind of investment alternative he choose. Now an investor would like to select such a combination of securities or such a combinations of investment which maximize his utility, means which maximize his satisfactions, okay, or which maximize his benefit or profit. Now, investment can be categorized as direct investment and indirect investment. Okay. Now, suppose when an investor um, buy any kind of investment, okay, whether it can be a fixed principal investment, variable principal investment, or like convertible form of investment. If the investor is making the choice by himself, so in that case it is known as direct investment. So in direct investment, the investors make his own choice and take his own investment decision. There may be fixed principal investment, variable principal investment, and non-security investment also. Non-security investment means it can be a buying of a property, it can be a buying of any real estates, right? Buying of golds, jewelry. So that is also an investment. So that is non-security investment, okay? Or buying any company shares or company debentures, government bonds, right? So if an investor buying and selling of the investment by her own knowledge and decisions, that is direct investment. But when an investor don't have any idea on how to make the investment, in that case he or she may go for a help, right? So here in case of indirect investment, here the investor has no control over his investment decision. That means he don't have any control over the investment, but investment decision is taken by the agent, okay, by the agent. Simply he is putting the amount, he is giving the amount to the agent, and agent on behalf of the investors is making the investment, okay, in indirect investment. Now let us take some example. So here we can see that in case of direct investment, suppose the investor is making investment in cash, bank deposits, purchasing saving certificates, or buying any government bonds, corporate bonds, or debentures, or buying any equity shares, preference shares, convertibles, buying any estate mortgage, commodities, business venture, art, antiques, other variables. So all this buying of non-securities as well as securities investment will come under the direct investment decisions. But if money is invested through the pension fund, provident fund, insurance, investment companies, or unit trusts of India, or mutual fund, here the investor is simply putting the investment into this fund, and the fund manager, here the pension fund authority or the provident fund authority or the insurance companies, they are taking the investment decisions. They are deciding which securities to be bought or where the amount has to be invested. Okay, they are taking the investment decisions, not the investor. Next that we are going to discuss is about the risks. So whenever a person is making any investment, obviously there will be some risks, right? There will be a risk of loss of the principal amount, risks of loss of the interest amount, right? So the risks which is involved in investment can be categorized as systematic risks and unsystematic risks. Okay, so the total risks, both systematic plus unsystematic risks, is defined as standard deviation. Okay, so the total risks is measured with the help of standard deviations, and the total risks is categorized as systematic and unsystematic risks. Now, talking about the systematic risks, what is the difference between systematic risks and unsystematic risks? So systematic risks, it's refer to that portion of the variation. Variation means the difference between the expected return and the actual return. Okay, now for example, you are expecting that you will be getting 30% return if you invest in Reliance company, say for 1 year, but the actual return that you receive after 1 year is say only 20%. So the expected was 30, but you have received only 20% return. That means there is a 10% loss, right? 10% loss. So that 10% can be categorized as variation. Okay, so variation, or you can categorize it as a loss, right? Kind of a risk, right? So so in systematic risk is that part of the risk, total risk, in the return which is causes by the factor which affect the price of all the securities. That means systematic risks are that kind of risks which affect all type of securities. Okay, systematic risks cannot be avoided. Systematic risks are those risks which cannot be avoided. Now, say for example, the risks related with the coronavirus. Now, the sudden outbreak of the coronavirus has brought upon a very big change in our economic system, right? So the sudden outbreak of the coronavirus has affected various type of industry, not in one particular industry, but various type of industries has been affected, right? Whether it is like textile industry, avians industry, hotel industries, various service industries, various type of industries has been affected by coronavirus, right? So so we can say that the risks, suppose you have invested in a particular industry, suppose in tea industry you have invested. Now the loss after 1 year, the loss that you have suffered, now that loss was due to the sudden outbreak of the coronavirus, and it is so that was the risk, right? So that risk is so systematic that it cannot be avoided. That means even if you invest in any other industry, then also that risk would then also it would have affected, right? So systematic risks are those risks which you cannot avoid. Okay, so systematic risks, it cannot be eliminated. That